Well, joining us now is Larry Schofer, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. Thank you for being with us. We'll start with a look at the broader market before delving into some of those energy plays. We did see certainly strong gains on the session on Wall Street today, but we are seeing investors eyeing somewhat that imminent tax announcement from Donald Trump. Where do you see U.S. indexes going to from here?
Well, right now we're focusing on the micro. I mean, the macro earnings were decent. You look at industrials, semis, by and large, earnings really good. And I think the market has been so overly focused on geopolitics, on politics in general. Now the earnings are front and center. I mean, Eurozone earnings are the best they've been in a long, long time. And here in the U.S., we're coming up to the busiest 5-day period in probably 10 years with regards to earnings. And so far they've been good. People are focusing on that. But I do need to say that as the S&P climbs towards 2,400, there seems to be a boatload of anxiety as compared to when the S&P is closer to 2,300. So right now, a lot of nervous people out in the market, although and seeing a lot of short covering in the afternoon.
Despite that nervousness, though, as you flagged, Larry, we're seeing the VIX index, it slumped, I believe it was 25% as we were chatting a little bit earlier with Kenny Polcari. So despite this feeling of nervousness, that not translating through into volatility.
Yeah, I think you're exactly right. And that's the chorus that we've been singing for a very, very long time, that, this is the most hated market rally in history. And whenever people continue to get anxious, they get, they just don't like the market continues to climb higher. I mean, let's keep in mind that this is the first synchronized global recovery that we've seen since 2009. And I think people are just focused on, the things in the corner and missing the big picture that, the globe is growing.
So let's take a look then at the energy space. Really, year to date in the US continues to be the most beaten down sector. And given some of the outlook, we're not set to see that change for some time to come. For the likes of BHP, Billiton, Rio Tinto, we saw Goldman Sachs a little earlier in the week flagging a downgrade, as it were, for those iron ore miners. BMI coming through saying it sees iron ore prices $70 this year, $55 in 2018, something to $46 by 2021. How is this lining up with your own forecast, Larry?
I hope you're wrong. I hope you're dead wrong, because I'm really hoping that right now we're just in a consolidation phase. It's really hurt. I mean, I've been on the wrong side of the trade for the past 4 weeks, I'd say. It's beyond wishful thinking. I just do hope in general that when it comes to the industrial and the base metals in general, that it's more of a consolidation phase and the market just overrunning itself. And I do hope we see iron ore prices snap back at least to that area of $80, which seems like a far way away. Realistically, will it get there? I think it can, but I think we need to wash out the weak hands, a lot of the the CTA and institutional money, speculative money. Also need to keep an eye on China. A lot of people think China is plateauing with regards to, building, et cetera, et cetera. However, people didn't see what China did last year, that no one saw it coming. So I am hopeful. I'm not overly confident, but I'm hopeful that we'll see closer to $80 by the end of the year.
Meanwhile, switching our focus to oil, we've seen oil snapping its 6-day losing streak. This ahead of that U.S. inventory data really becoming, Larry, that weekly driver. Just lead us through what it is that you're expecting when it comes to inventories this week.
Well, I have to start off by saying last week, inventories actually really made me feel a little bit more stable on the oil price. I kept thinking that we're going to see a higher price. We're down 7% last week with the trouble in Korea, the significant trouble in Venezuela, also the proposed changes in relations between the U.S. and Iran. All these things could really upset exports, but down 7%. So right now, I think inventories are very, very important. However, the impact of them seems to be a little bit shallow. I mean, the bottom line with oil, at least on the WTI side, is that the Atlantic basin just doesn't seem to be able to change its, surplus. It seems to be ever flowing. And until something gives, I do think we're going to wallow between that $49 and $52 a barrel. I'm still hopeful that we'll see a higher oil price. I do believe Brent will be closer to 59 by the year end. And I do think WTI probably about 57.
Just within this mining space, Larry, what would be some of your stock picks? As flagged, we have seen Goldman Sachs turning negative on the likes of BHP Billiton and also Rio Tinto. BHP very much in focus here on the local session. We have expectations of their sales and revenues report coming through to market today. But who do you watch particularly within this space?
The one metal that I'm watching, I watch all of them. I have positions in all of them. They have not treated me well the past few weeks, but I do believe copper is the one where I feel the most comfortable being long a little bit more than everything else, even though it has not been pleasant. But I do believe right now the market is being washed out just more for non-fundamentals and fundamental reasons. And I do believe, with that said, we're going to see a bounce back in the price. And so when it comes to securities that are mining copper, I think I'd rather look at companies that are more downstream than upstream. But with that said, I do think that's the one I would watch, copper.
So let's consider also then sort of broader portfolio outlook. What is your weighting at the moment?
Well, it hasn't changed from last week. I went neutral on Japan 2 weeks ago. I'm neutral in the United States, overweight emerging markets, especially China and India, probably a little bit more India, and definitely overweight Eurozone. And I continue to see, I think the one thing is the banks in the Eurozone. There's a breakdown right now between the correlation between yields and the propensity for banks to do really well. So I think valuations are good. I definitely like Eurozone the best, especially in the banking sector.
So in terms of to consider the fallout from the weekend and the French elections, naturally we did see a surge in European markets, that coming off somewhat. But it's the banking space particularly that's caught your eye. Why is that?
Well, I think there's a breakdown. Yields have come off, as we know. Like German bonds are overbought. I do think oversold. I'm sorry. And I do think we're going to see a slightly higher yield environment. But even if we don't, I think even at the yields we're seeing presently, I think there's a disconnect right now in the market between how well banks can do even in this yield environment. And like me, I do believe yields will go higher. So it's all the more for Eurozone banks. And I think they're 2 to 3 years behind the U.S. in valuations. So if you want a big bang for your buck, that's where I put my money.
And certainly we will be continuing to watch them closely in the lead up to the final round of French voting. Also, naturally, we are eyeing that UK election also to take place in June. Larry, we're out of time. Thank you.
Yeah. Thank you.